Today I'm going to show you a great way of generating passive income simply by holding the stocks you already like to own. In this video I'll show you how you can turn any stock into a dividend paying stock. Hey value investors, how are you doing? My name is Stijn and welcome to my YouTube channel. Now let's get into it. So to generate that sweet passive income, I promised you guys we will be using option contracts, specifically the writing of call options. But to understand what writing call options means, we first need to understand options in general. Options are financial derivatives, meaning they reflect the value of the underlying in one way or the other. Apple, for example, is a company which is traded as a stock on the Nasdaq Stock Exchange. Currently it's worth around $150 per share. However, if we head over to the option sections, we'll find that Apple has plenty of options to trade as well. So call options, put options, and of course plenty of different expirations. On a fundamental level, options basically have four different variables. First, the underlying, meaning what is the underlying company, stock or ETF it is being traded for. Second, the strike price. When buying or selling an option, this is basically the future value you are betting on. This is the future value you think Apple will trade over or under, for example. Third, we have expiration date. This is the date until when the option is valid. After that date, the option simply stops existing. And lastly, for now, we have the premium. This is the current price of the option contract. Cool, so those variables are the most important ones when trying to find out what options you want to buy or sell. Now the main point of this video, writing call options. When you write or sell a call option, you sell someone else the right to buy 100 shares at the strike price until expiration date. And of course you yourself are obliged to sell your shares at the strike price whenever the other person demands so. And for this promise to sell 100 shares, you get the premium. Of course this is hella complicated, so in dum-dum language, you promise to sell your 100 shares at the strike price if the other person demands so until the expiration date. And of course for this promise you get paid the premium. Example time. Imagine I hold 100 shares of Palantir and I would love to generate some extra passive income simply by holding those shares. And to do so, I am looking to write a call option on those 100 shares. I can for example write a 5th of November call option with a strike price of $27. At last Friday's close, I would have received 27 cents for this contract. So for 100 shares, I would have received $27. So you gotta remember that the last price depicted here is always on a per share basis. And an option contract is always about 100 shares. Anyways, $27 might not sound like much, but that would be a 1% return in 5 trading days. According to Google, there are 253 trading days in a year. So if you were to do this trick all year, you'd have an annualized return of over 50%. Not bad. Basically doing this trade, I would have promised to sell my 100 shares at a profit if the other party so desires until Friday. And of course, if the buyer of my call option wants to, he can force me to sell my shares at any time until expiration. However, early exercising doesn't happen often. And most probably, if you get assigned, it would happen after market hours on the day of expiration. If you ever get assigned, so if the other party forces you to sell your shares, well, then I would recommend not freaking out about your portfolio too much during the weekend. Some brokers do weird magic tricks to facilitate this transaction and it might seem as if you are in big trouble. Personally, when I got assigned for the first time, I almost thought I owed my broker thousands of dollars. But if you followed all the steps correctly, everything should be perfectly normal come Monday. Hopefully after assignment you automatically sell the shares and keep the cash. If that hasn't happened yet, on Monday you can always give your broker a call. So again, we promise to sell 100 shares until expiration if he or she so desires at a freaking profit. This is a promise I do not mind making at all. I do not mind selling my shares at a profit if that means I can squeeze out a lot of passive income throughout the year. Now a couple of rules I personally use for writing call options. First, never sell a call option with a strike price you do not want to sell your shares for. After all, you do not want to be forced to sell your shares at a loss. Second, do not sell options with too much time until expiration. Sure, you will get great returns from each of these option contracts. However, I have found it to be more lucrative to sell multiple shorter term call options rather than one long term. Third, the most important rule, always make sure your written call is covered. Meaning make sure that if you get assigned, even if it's early assignment, that you actually have the shares to sell to the other party. Otherwise, well then you messed up big time. However, there's actually one situation where I do not mind writing call options even though I do not have the shares to sell. And that situation is the poor man's covered call. This is an awesome strategy for which we need to understand two things. First, obviously writing a call option. Second, a LEAPS or long-term equity anticipation security. Fancy language, I know, but this basically means an option contract with an expiration further out than 1 year. The poor man's covered call works like this. You buy a LEAPS on a company you love, preferably in in the money. So with a strike price well below the current share price of the company. And then over time you can write multiple shorter term call options over that one leaps. And by doing so you can sell the short term call options to generate that sweet passive income even though you did not put in the capital required for the full 100 shares. Example time. So basically what happens if you get assigned on your written call option, you would have to sell 100 shares of the company, for example at $100 per share. However, because of your leaps with a lower strike price, you also have the right to buy 100 shares of the same company at, for example, $80 per share. So you exercise your option. You buy those 100 shares at $80 per share. And then you can instantly sell them for $100 per share. Of course, after the transaction is done, you keep the difference. Additionally, you keep all the premiums you received on your written calls. A pretty sweet deal if you ask me. Now, some rules I personally use for the poor man's covered call. Do always make sure that you sell the shorter term call options with a higher strike price than your leaps. If you do not do that, you basically increase your risk tenfold. If worst case came to be, you would have written a naked call in this case. And trust me, you do not want to write naked call options. Second, make sure that if you get assigned on your written call, you're at least net profitable. We do not want to liquidate our leaps on an awesome company for a loss. At least I sure as hell don't. Now, on what stocks or companies should you write call options? Well, any stock really. During the intro, I promised you guys that using this strategy you can turn any stock into a dividend paying stock. And that is true provided the stock has option contracts. Smaller companies, for example some trading on OTC or over-the-counter markets, do not have option contracts. So there's that. However, if those companies grow enough and they go to a larger stock exchange in the future, then chances are they will gain access to option contracts. So you can use the strategy on any stock which has option contracts. However, some are better suited than others. Generally, the more volatile stock is, the higher the premiums of the options are. And higher premiums is a great thing if you are writing call options. After all, that means more juicy passive income for you. You can actually see this for yourself in your own brokerage platform. A lot of great brokers show the Greeks for the option contracts you're looking at. You can use the Greeks to gauge how profitable writing that specific call option should be. Or you just do what I often do. You calculate the percentage return you'll get against your position. If the return is above 30% annualized, I go ahead and write the call option. If the return is less than 30%, I often rather just hold the shares without promising anything to anyone. Awesome, so by either writing a covered call on the shares you already own or by opening a poor man's covered call, you can squeeze out a ton of passive income out of the market. As said earlier, I prefer to use the strategy on volatile stocks since those generate way more passive income. I've personally found that ASTS and Palantir are great companies to use strategies like these on. And that is of course because their option premiums are juicy. Of course, I have done plenty of analysis videos on those two companies, so you can definitely check those out if you would like. Links will be in the description. Additionally, you can supplement writing call options where you promise to sell your shares with writing put options. This is where you promise to buy shares instead. My explanation of that strategy will be linked here, but also down in the description. If you guys have any remaining questions, drop them in a comment, I'll get to them as soon as I can. Also, do let me know if you are interested in learning more about leaps. We have talked about them today, but I would love to do a follow-up in-depth video dedicated to leaps if there is enough demand. That said, I really hope you guys enjoyed this video, and if you did, please give it a like and maybe even subscribe. Comment down below what you want me to talk about next, and I'll see you guys in the next one. Peace.